Hello, everybody, and welcome to MoneyHub Live, how to build a financial plan. I'm your host, Doug Shepherd, and we're super excited to be back with more webinars. It's been a little while since we did our last one, but we've got two very special guests for you. We've got James Blair and Michael Vincent from Lighthouse Financial to come talk to you about how to build a financial plan. So without further ado, I'll pop them onto your screens, and then I will let them run away with a 30-minute presentation before I come back and give you some Q&A. Take it away, guys.
Awesome. Thank you very much, Doug. I always like being called special, Michael.
Yeah, it's not often I get that.
So we have had a quick look at the Slido questions that have come out beforehand, and there's already a truck ton of them. We've got a presentation we're going to work through, but we want to spend some time in that Q&A, don't we?
Yeah, we struggle to keep anything under 30 minutes in a presentation because we like to talk quite a bit. So I reckon we just crack into it, man.
Yeah, so if we can bring up our slides, and then we will jump into them. So I think one thing that's important to touch on before we start, we'll do a quick intro, move into it. Everybody is, apparently we've had 2,000 people register for this webinar, which is the biggest webinar for MoneyHub in its history. So thank you, everybody. The biggest thing is everybody on this call is at a different stage of their life, a different level of financial literacy. So we're going to try and hit something that's going to work a little bit for everybody, right, Mike?
Yeah, and that's why I want to spend quite a bit of time in the Q&A section at the end. And, you know, if you haven't downloaded the app already, make sure you pop in those questions through YouTube or Slido because we love answering them.
Oh, some of the questions in the Slido are already bangers. Mike, for those that don't know anything about Lighthouse, give us the mission.
Yeah, look, so here at Lighthouse Financial Services, we've got a pretty astronomical mission ahead of us. Our mission is to secure 50,000 Kiwis' financial futures in the next couple of years. Now we're sitting in around about 4,000 to 5,000 now, so that's a pretty steep hill to climb. Now that is an aspirational goal. So when we break that down, we go, right, how does that look like in terms of a bit of an equation? Well, we've got education plus action, and you'll hear us talk a lot tonight about taking action. And then, you know, a little bit of time in there will get you to that financial freedom. And that's really what we're aiming for here.
Don't worry, the action is not like sign up to our crypto course or anything like that.
Yeah, it's no get-rich-quick scheme.
Yeah, today's just giving you some information. Just a little bit of a credibility statement around like why you should listen to us. This is our vanity slide. So Michael and I, apart from being best mates for 15 years, I'm the wealth director at Lighthouse Financial. Mike is the mortgage director. We've taken over 13,000 people through our webinars. 95% love them. The other 5% apparently it's to do with Mike's haircut. A lot of big companies we've worked with, and we have a podcast, Cheques and Balances, that Mike only found out the other day has 75,000 downloads a month. We were down interviewing Nicola Willis at the back end of last year, which was cool. We'll pop a link in the comments for those who want to follow along, or you can just search us up on YouTube. Michael, we do need to disclose something here.
Yeah, so both James and I are financial advisors, so we do need to give the boring old disclaimer. So everything we're talking about tonight is not personalized advice. We are just talking in general terms. If your question, you know, like I said before, we love the Q&A function, so make sure you throw a ton of questions in there. But if your question is, I'm 20, my partner's 22, I earn this, they earn that, what KiwiSaver fund should I be in, how much can I borrow, that's personalised advice. We can't do that on this forum. We'll just tell you to book in with us.
Yeah, especially because it's a recorded.
It's a recorded one. Yeah.
So before we get into what's happening in terms of, you know, how to build your financial plan, we're going to point out, Mike, it feels like it's been tough in New Zealand for a little while now.
You reckon? I don't think there's much going on out there at the moment.
It's pretty easy times.
Yeah, easy times.
Wind at our back.
Yeah, absolutely. No, look, hey, so it's been quite a wild ride since 2021 in New Zealand. Obviously, we had those huge, like, sugar low interest rates, and everyone was running around buying everything. And then this little thing called inflation creeped in. And that hit about 7%, I think, at its upper limit, which is pretty bad in an economy, right? So the official cash rate went up, interest rates went up. Everyone's discretionary spending, it went down. So it's been pretty tough times. The property market had a bit of a drop off the back of that as well. And I'd have to say, apart from Christchurch, it hasn't really come back. It's kind of been...
Queenstown.
Queenstown as well. It's down about 17 to 20% across the country, apart from that kind of Canterbury and Queenstown area. At the moment, you know, the official figure is we're sitting at 3.1% inflation. I will eat this entire building that we are sitting in if our inflation number at the moment is 3.1%. I predict it will be much higher than that.
That's a big deal, Michael.
Yeah, it is, but you cannot double the price of oil, diesel, petrochemicals in an economy and not expect there to be a massive amount of inflation.
I hear from Donald Trump, though, deal's very close, about to handshake on the deal.
Yeah, look, there is a deal at the moment, and we have seen swap rates, the overnight swap rates, drop off the back of that. That's the wholesale price of money. But that doesn't necessarily mean that interest rates are going to drop. In fact, we've got the official cash rate, which has 2 price increases fully priced in towards the end of the year. So I anticipate that interest rates will be increasing off the back of that.
Yeah, so interest rates being really high meant property prices went really low. Property prices are about 1.1% down over the past 12 months, but probably about 20% down from the peak. The share market, though, is a good news story. So anybody with a KiwiSaver balance, anybody with an investment account, shares account, whatever it might be, will notice that it's been performing really, really well. The S&P 500's up about 100% over the past 5 years, and over the past 12 months, up about 16%. So while the local story is very concerning, the international story when it comes to investing is incredibly strong.
Yeah, absolutely. And again, like this is just kind of giving you a quick rundown of what's actually happening in the market, because it's really easy out there when you're kind of, I don't know, watching TV, reading the news, reading stuff.co.nz to go, it's doom and gloom, and I'm going to make decisions based off the back of that. And, you know, what we're talking about tonight, how to build a financial plan. If you've got a solid financial plan, you know, it doesn't matter what's happening in the next 3 months or 6 months. We should be able to look past that and stick to the plan.
Yeah, and that's probably the really big piece, is a really good financial plan. It doesn't matter what's happening in the world right now. You need to have an emergency fund, the right structure to protect yourself when something bad might happen, because of course things will bad will happen to everybody in their lives.
Like that haircut.
This haircut, I mean, in the comment section, I can't see the comments in YouTube, but I've got the beard done, the hair's trimmed. Mike's got the Ellen DeGeneres look going, but we didn't sort it out. I don't know. But coming back to the plan, you know, it's completely irrelevant what's happening in the moment. You need to go, what am I trying to achieve over the long term? And everything else is just noise. Trying to time the market, trying to go, should I do something now or in 6 months, is a complete waste of time. It's going, what am I trying to achieve? And executing and being consistent over time. Our approach to financial planning is pretty straightforward. Everything is really a balance between enjoying yourself now and enjoying yourself in the future. Most people, not looking at anyone in particular, tend to focus on the now. Mike was telling me about how baggy clothes are back in, and I'm like, that means you're going to get a new wardrobe, doesn't it? So his financial plan's screwed. But most people tend to focus much more on the now and not setting themselves up in the future. There is a group out there who Scrooge McDuckett actually never get to enjoy their money. So everything is about balance, and money is just a tool to help you live the life you want to live, and that's really how we think about a financial plan.
Yeah, it's a bit of a tug of war, right? And it's present you versus future you, and you just don't want future you to end up face down in the mud.
What a nice analogy, Mike.
Banger.
So this is our blueprint to helping people build their own financial plan. So take a screenshot. This is really all you need to know.
Yeah.
We're giving away all your secrets. We charge people to do this, to put this together for them. The first thing is around understanding the goals that you're trying to work towards. I'm going to break that down because it might be a little bit heavy on a Tuesday night.
Yeah.
Getting the house in order. So if we've got any bad debts, sorting them out. Understanding that our biggest asset is our income. So going, actually, how do we increase this? How do we respect it? Which we will talk about budgets.
Yep.
And then, you know, focusing on getting onto the property ladder for most people, maybe talking about investment property and investing into shares. And if we're consistent over a long enough period of time, once we've got the plan, we're a few years in, the idea, Mike, is the plan gets quite boring.
Yeah, 100%. And you'll notice here on the screen, none of this is revolutionary, right? We are not selling you a cryptocurrency, an NFT, the Eiffel Tower. There is no get-rich-quick scheme here, right?
NFT of the Eiffel Tower?
Yeah, we're all about getting rich slowly. And again, finances should be boring. You should not be spending, you know, an hour a day trying to manage your finances. If you're doing that, I'd have to say, like, you're doing it wrong.
100%. So let's come back to the goal setting piece, because the most important thing is, how do you know if you're on track if you don't know where you want to go? So the good thing is we've got a little bit of study to back that up. There was a study done at the University of California which broke down 5 different ways that you can set goals with, you know, differing outcomes. So Mike, let's go through these one for one.
Let's do it. Right. So group 1 was asked to think about a business-related goal that they hope to accomplish within the next 4 weeks.
Group 2 wrote it down and rated it in terms of difficulty.
Group 3 wrote them down and then put an action commitment next to each goal.
Group 4 did all of the above, plus they had a friend that they told about the goal.
Look at that. Group 5 did all of that again. In addition to just having the friend, they also sent weekly progress updates to the friend. So they checked in. What do we call that? Accountability.
An accountability buddy, just like you and me at the gym. Where were you this morning?
You're not there.
So there's these results, probably not surprising. The people who just kind of thought about something, 43% achieved their goals. But Mike, the group that had weekly updates, 3 out of 4 of them got done what they wanted to.
Yeah, and again, we're not saying like you have to get a financial advisor to do the check-ins, right? This can be your spouse, it can be a friend, it can be your parents, it can be anyone. But it's really important, because we all look at this and before we even read out who was the most successful group, you all knew it, right? But then you go, okay, why don't people do that? Why isn't it that everyone goes, I know to do this, I have to be successful, so I'm just going to go do that already?
Well, do I know how to get a six-pack? Yes. Do I do what's required? No. But one day, Michael, one day. Summer is coming, so I am told. So that is how to, the best process to set goals. The next piece is going, actually, what are the specific goals that I'm trying to achieve? And I've been giving financial advice, putting together plans for well over a decade. And let me make it nice and easy for you. There's 4 things that most people want. Where are you going to live? Are you going to upgrade, downgrade, renovate? When are you going to do it? How much is it going to cost? Because that's going to impact the plan. Point number 2. What is the cost of your lifestyle right now? Are you going to do all the things that you're wanting to do? What is happening with your budget? Do you have a surplus? Do you have a deficit? Point number 3, retirement, financial freedom means different things to different people. What does it mean for you? If you have a spouse, they might have very different opinions, Mike.
Yeah, absolutely. And trying to get them on the same page can also be a bit tricky.
And goal number 4, Mike, you see all the time as a mortgage broker, you might want to, say, for example, help your kids get onto the property ladder.
Yeah, and there's different ways you can do that, right? Like a lot of people just think of the traditional, like when I pass away, I'm going to leave this to my kids. But people are living longer, right? So by the time you pass away, a lot of the time you've got grandkids, So, you could help them out at that point, but they kind of don't really need it by that point, if they've been grafting away.
Yeah, there's the concept of like a warm inheritance and a cold inheritance. And the thing with all this stuff, you do whatever the hell you want to do. Like, it's your life. There's no right or wrong within this. But the big thing is when it's all said and done, all of your money should be allocated towards whatever you want to do. If you still have money left over when you're projected to die, then, either spend more, give some away, retire early, do something with it.
Yeah.
Otherwise, it's unallocated resources.
Yeah, and a lot of the time we struggle to get people to spend money going through retirement because they've worked so hard to get it, they're worried it'll run out.
Yeah, absolutely. So that is like an example of some good goal setting. The next piece is going like, well, how do we break down a goal? This is probably one I see quite a bit going, James, at 65, I'd like to retire. I'd like to have an income of $100,000 a year. Based off some numbers, including New Zealand superannuation, you need about $1.1 million if you're a couple, including New Zealand superannuation. A lot of people might go, $1.1 million bucks, I don't have it. And I think with any goal, assuming you have some time on your side, you can't think about, going to the summit. You've got to go, what are the small consistent steps that I need to take that will build wealth over time? So for example, if you want $1.1 million in 15 years, that means that New Zealand Super covers, nearly half of the income requirement. Over that 15 years, you need to save $70,000 a year at a net real return of 4% to get to that outcome. Now, that still sounds really scary. That's $2,900 a fortnight. And then the last bit, Mike, is if I go, well, I want that outcome, but I can't save $2,900 a fortnight, what should they do?
You just give up, James. No, look, you can do one of 2 things, right? You can change the timeline to achieve the goal, or you can change the goal itself. So you might say, well, look, actually, I don't just have 15 years. I could work a little bit longer.
Part-time.
I could work part-time, or I might start this earlier, at which point, the amount you've got to save per fortnight would reduce, or you could change the size of the goal. Basically, you go, look, you know what? I can't achieve that based on the runway that I have realistically. So I've got to kind of readjust my expectations in the goal to make sure that I can achieve it. Because the worst thing here is basically, You look at 2,949 and you go, there's no way I can achieve that. So I'm not going to try. I'm going to give up.
Yeah, and like once again, there'll be people at lots of different stages of life here. Another example would be credit card debt and going actually consistent steps, getting onto the property ladder. If you have a partner and you've both been contributing a KiwiSaver, that can build up quite quickly as well, can't it?
Yeah, absolutely.
Alrighty. Let's talk a little bit about the difference between rich and wealthy. Michael, try not to rant too much. What is the main difference between being rich and being wealthy?
Yeah, cool. So the main difference we see between being rich and being wealthy is that wealthy households have, invested into income generating assets over time, and those assets start to pay them an income. And a lot of people will say passive income. I don't believe anything's really truly passive with an income, but they start to pay them back an income over time. What that does, it means that takes the pressure off them having to earn money through their salary or their business, which means they just have choices, right? And again, we see a lot of people who earn a lot of money, $1 million a year, who are going backwards every fortnight because they are in a rich household, they don't have any passive income coming in, and they are spending more than they are earning.
Yeah, and it's just lifestyle creep that consistently happens over time. The way you make sure you're a wealthy household instead of a rich household is, one, understanding where your money is going in the form of a budget. There are 1,000 ways to put together budgets. It's up to you, the structure. We help clients here in terms of how to manage their money like the best way possible. But you have to have like a budget that you're working towards, a surplus, and money is quite simple. It can really only go into three things. You pay down debt, you invest into shares, or you invest into property. Yes, business, yes, crypto, there's a couple of other things, but fundamentally that's all it is at the end of the day. Rich people care about looking impressive, but as soon as they stop working, as soon as their income drops, they're off the treadmill, they can't maintain the lifestyle. Wealthy is all about going, if I don't turn up to work tomorrow, I've still got that income paying me and I have choices. Right. Now, Mike, one of the biggest nooses around people's necks is their mortgage. And it's very easy just to flick it onto a 30-year P&I, but there is a better way, and those small, consistent steps can make a meaningful difference to people.
Yeah, and we talked at the top about taking action, right? And this might be some type of action that you can take off the webinar. You don't have to go out and buy an investment property tomorrow. It might just be reevaluating your mortgage and going, right, here's what I'm going to pay down. So getting debt-free earlier, right? Really easy to do in theory, a little bit tricky to do in practicality. But let's put some numbers behind it. Let's say you've got a $600,000 mortgage at a 5.5% long-term average interest rate. You're paying $850 a week in repayments. So let's say we allocate another $281 a week towards that mortgage. You'll pay it off 10 years earlier. That all sounds great, right? But it's not really about kind of what you're doing with it now. It's what you do with that money after. But if we look at the savings, that's when we really start to make an impact here. So let's say we just left it on a 25-year term. You will pay $504,000 in interest on that mortgage. Let me just lay that out for you again. On a $600,000 mortgage, if you leave it on a 25-year term, you will pay roughly $500,000 of interest. That is phenomenal.
You're paying for the house twice.
Back, effectively, right? So let's say we drop it down to a 15-year term, right? So we increase our repayments to $1,131 a week. You will save, James, $223,000 in interest. Forget crypto. Forget everything else. Forget the get-rich-quick scheme. If you simply increase your regular repayment, this is what it can do, right? So let's say we go, right, roughly $1,131 a week. Fine, we can do more than that. We can chop that right down to a 10-year repayment term. $1,500 a week, you will save $324,000 in interest over the life of that loan. And like I said at the start, this is just maths, right? Really easy to follow. Increase your repayment, pay less interest over time. The really exciting thing is actually what you can do with that money after you've paid it off. So let's say you left that loan on a 25-year term. Congratulations, you've paid your house off. That's not a bad thing.
Still an achievement.
Having a debt-free house in 25 years, that's still an achievement.
But you've only got a box to live in. You don't have income.
Exactly, right? And I think that's where people go wrong with this, is they see their owner-occupied house as an investment. Like, yeah, to a degree it is, but it's only an investment if you sell it or if you camp on the front lawn and rent it out. So then let's say we paid it off in 15 years. Let's say you took that roughly $1,131 a week and invested it for 10 years, you would have roughly about $734,000 in a portfolio by year 25. Let's say you paid it off in 10 years and you invested that $1,500 a week. For 15 years, you would have about $1.56 million in the portfolio after year 25. So again, these are just numbers to illustrate the power of small, consistent steps. And, if we look at increasing your regular repayments by about $200 a week, is that the sexy thing to talk about at the barbecue on a Saturday? Absolutely not, right? But again, these are the sorts of things that are going to make you better off over time. Yep, it's heaps of fun to talk about some Korean EV manufacturer that we all invested in on Sharesies. But, 99 times out of 100, that's not the way to actually make a meaningful difference in your financial future.
Yeah, it's like the mate who's tells you about their multi over the weekend.
Yeah.
They haven't told you that they've lost money for the past 10 years and finally got lucky on one. Our advice is about high probability plays.
Yeah.
Yes, we want to grow above inflation. Yes, we want to be smart about it. But the sooner you accept that creating wealth is slow, not fast, and that's why there's always going to be demand for these courses, on crypto and trading and all these different things. If you are a professional, and we're assuming the people on this call aren't, that have busy lives, you should have a plan that is simple to execute. And if anything is the simplest, is buy a house to live in, because statistically, you're going to be better off over the long term.
Yep.
Pay down the mortgage, invest into shares. They are great starting points, and we'll talk a little bit about investing into shares in a little bit in the presentation. Only thing I want to touch on is the 4% net real return is like a 10% return less tax, fees, and inflation for those wondering.
And just quickly on that, for everyone looking at that going, I don't have that type of money, right? Like what we're illustrating here is a principle. If you don't have an extra $200 a week, that's fine. But you just need to, we start like we always do, start with the foundation, start with the budget, get the house in order, and then go, right, what are the steps that I can take to make that difference? It might be $20 a week. It might be $50 a week. All of that adds up over the long run.
Yeah. And the other thing that's very easy to forget is the New Zealand economy has been an absolute hole for the past 4 years. Cost of living won't stay forever. The economy will improve. The job market will improve. Asset opportunities will improve. But if you have a mindset going, this is all against me, of course you're going to be right. You're going to, not be able to achieve your goals.
Yep.
Now, Mike, as people pay off their mortgage, as the value of the house, in theory, they tell me, back in the day, houses go up in value, apparently in the past.
Just keep going down?
Leverage becomes available. Talk us through a little bit from a mortgage broker's perspective. How do people use the equity in their home to buy an investment property?
Yeah, absolutely, right. And I'll acknowledge my conflict of interest here. I'm a mortgage broker, so I'm all about this stuff, right? But fundamentally, the only two kind of advantages of property as an asset class are the ability to use leverage and tax advantages. And we anticipate those tax advantages will go away at some point in the future, but the leverage bit, that's probably here to stay. So if we think about how we use leverage in our owner-occupied property to build an investment portfolio, here's an easy breakdown. Let's say we've got $1 million property and we can lend to 80% of the value of that property. So that's our owner-occupied home. Let's say James and I live in that, right? We've got a $600,000 mortgage, so we've chopped it down a little bit. The difference between the maximum amount that we can lend, so that 80%, 800,000, and our current mortgage balance of 600,000, we call that usable equity. And so long as we can afford to borrow that back again, we can take that and use it as a deposit on the next property. So, with that example, depending on the type of property, you could potentially go out and buy another $1 million investment property. Now, am I saying you have to go out and buy $1 million investment property? Nope, absolutely not. Am I saying you have to use the leverage in your property? Nope, again, you don't have to. However, when you hear people talking about growing portfolios, this is usually the mechanism that they use to do it.
And it's not about going property good, property bad, shares good, shares bad.
Yeah.
The thing I would encourage you is to understand these assets and go, could this work for me? We've also got a real life example. So like when you pay off your mortgage, you're not a slave to the bank anymore, which most people are for their lives. But when you start to look at investment property, if executed properly, then you are leveraging the banks and you're making the most of that situation, that lending. So we've just got an example here. The reason why property is so attractive is because we turn equity that we're not utilizing, that we can't use in shares or anything else, and we're using it to buy property. So let's say we buy a $700,000 property. We've got all of our costs. We've got interest, we've got rates, we've got insurance, property management, accounting, etc. And we've got rent of about, I think, $700 a week, including some vacancy. This type of property, and there's different types of properties we'll talk to you about, you're topping this up by about $16,000 a year. The property on average over the long term, granted it hasn't happened for a few years, Michael promised me at some point it will go up, increases on paper $35,000 a year on average.
Which is just your 5% annual growth.
Yeah, that's right. Long term, 6.5%. $35,000 in capital gains. I'm topping up by $16,000. My return is $19,000. Sounds like a scam. It's 100% return on the money that you put in, but it's really just utilizing the bank's money and getting to keep all of the profits. So property will make you rich on paper over time, which works well for people who have income and a long time horizon. But when you get to retirement or need income for most types of property, you won't get meaningful cash flow opposed to shares, which we'll talk about in a second. Cool. Now, Mike, people will argue in the comment section. I can see it already, 500 podcasts in. People will go, 5% annual growth rate, you're crazy. Why is that realistic?
Yeah, look, past performance is not an indicator of future performance. That's the mantra that we as financial advisors always live by. I think I've got it.
Read the fine print.
It'll be on my gravestone, yeah. But look, fundamentally...
About your life?
Yeah. But look, fundamentally, property in New Zealand grows at roughly that per year for a couple of pretty easy reasons to outline, right? Supply constraint. We are not building enough houses on average to keep up with the increase in the population growth in New Zealand. Again, if we look at it over the short term, yeah, we might have got a little bit closer to it, but we're still not there, right? Our population growth usually runs at around 40 to 60,000 per year. So even if you look at this, right, we simply aren't building enough houses. Different cities in New Zealand experience this slightly differently, but there is a relative land scarcity around some of the major city centres. Christchurch at the moment, probably the easiest to build out of. Wellington though, I don't know if you've ever tried to build a house on the side of a hill in Wellington, that can be pretty tough. So geographically speaking, we do run into some problems around land scarcity. Also, we have other uses for that land around farming, that sort of stuff.
Data centers,
heaps of data centers
for the AI.
And then we've also got construction cost inflation, right? I don't know if anyone has built a house recently, but man, the price of that has gone through the roof. So, gone up 40% since 2019. We can all see the stats here. Really, all we're trying to say here is, in a down market or a sideways market, it's really easy to bash a particular asset class. Now, when I look at a property market that is down 20%, I don't look at it and go, that's never going to come back. That's finished. Tony Alexander told me it's, chuck that in the bin. I kind of look at it and go, look, reasonably speaking, that's on sale at the moment. So I'm not telling people to rush out and buy it, but if you are looking at buying, don't really try and negotiate the best deal possible because the market's down. It's already on sale. You don't need to go really hard on it.
Counter-cyclical investing does make a lot of sense. We've got a slide in here around the different types of investment property. Maybe just go and check out the podcast where we've actually put in full episodes talking about the different options.
Yep.
New builds, renovation strategies, commercial properties, they've all got their place. I'm just conscious that we want to probably move on to the Q&A.
Yep.
Let's talk a little bit about shares quickly. So when it comes to investing into the share market, there's a lot of different ways you can do this. I'll give you some really good core principles, and the same would apply to KiwiSaver as well. The first one and most important comes down to your risk profile. So making sure that you understand that if you're in an aggressive fund, that it can drop, 30% easily over a 12-month period, but you might hit 10% over the long term. And then when it comes to the complete opposite end of the spectrum and maybe a conservative fund, which is 80% in income, in bonds and cash and 20% in shares and property, there's still a cost with that. There's opportunity cost and understanding that you will grow a little bit above inflation, but it will be steady, but there will be less money at the end of the day. I hear the mantra around just invest into the S&P 500. The thing you've got to be conscious of when investing just into the S&P 500 is really you're only investing into 7 companies that have gone up a lot in value and the price to earnings ratios, the value of those companies compared to the profits that they're making are really out of whack compared to any long-term average. So you've just got to go, do I want to have all of my eggs in that basket to try and make a lot of money and get rich quick? Or do I want to diversify into other areas of the world, like emerging markets, into Europe, into infrastructure? Do I want some stability in terms of some bonds, etc.? How do I want to build that investment? And then the final component is around fees. And if you look at any active fund manager over the long term, which is a bloke in a stuffy suit going, I'm going to outperform the market, statistically, it is pretty much impossible to outperform the market over the long term. You should make sure your fees are low and reasonable and well diversified, opposed to paying a higher fee over the long term.
Yeah, absolutely. This must be the quickest we've ever run through.
I just think we've got some really good
Yeah,
questions. So once again, just be compared the opposite train of thought to, I guess, the opportunity potentially in the property market in the shorter term. Share market has gone up a lot. If you had money to invest tomorrow, I'd go, yes, you should invest it into the share market if that's the right thing for you, because you're investing for the long term. If you're trying to make money in 6 months, that is gambling. You do not know what your probability of success is. I saw a question in the Q&A around what is my likelihood of losing money in the share market, which we'll get to. And there's different types of shares that you can invest into. There's growth stocks, which are the tech stocks, where we think the value is in the future. There's value stocks. Probably the value stocks are like banks, mining companies.
They're not the sexy ones, you know?
No, they're boring, but they're producing really good levels of profits.
Yep.
And small caps are smaller companies which maybe aren't even in the S&P 500 or in the big indexes, but are providing reasonable returns over time. Just a couple other things to quickly point out. The first one is just around financial advice. So, the big thing to think about is if you are going to talk to a financial advisor, make sure you're clear on how they're getting paid, that it's transparent, and that if you're paying somebody a fee, you want to make sure you're getting value. The days are gone of just getting a product. You should be getting, this is the goal I'm trying to achieve. This is the plan I've got. If you've got somebody who's telling you can outperform the share market, particularly like the brokerage houses, the conflicts of interest around transaction costs, just be careful. On the flip side, DIY, you might go, I don't want to pay for a financial advisor. You should see the bill for not paying for a financial advisor. Even just the component of low-key marriage counseling to get people on the same page and the clear consistency over time. Because the thing I'd say about financial advice is anybody who tells you they've built the engine and their engine is faster than the other engines, they're the wrong person. The financial advisor is the captain. So their job is to understand the destination you're trying to get to and what is the most efficient way to get there while navigating the rough seas ahead, because there will always be tricky times.
When do we get the smooth sailing, we haven't had that for a while.
Like a wind at the back as well. Just a couple other really important things to touch on before we jump to the Q&A. There's 3 components to wealth. Where do you want to go, how are you going to grow your wealth, and how are you going to protect your wealth? Protecting your wealth is the least sexy. Make sure you have an emergency fund, 3 to 6 months. It's not about making a return on it. If you have money in shares, that's not an emergency fund. Yep. If you have a short-term goal, you should not be investing into shares. 50% of Kiwis don't have a will. Get a will. If you don't have a will, do not go cheap if you have meaningful assets, because the bill on the backside ends up being a lot more. And then insurance, we'll pop a link in if you want to have a free chat with an insurance advisor at Lighthouse. It's quite simple. If somebody is dependent on you, do not be ignorant. Get some life insurance because you need to look after them. If you're dependent on your income, make sure you get income protection. Yes, it can get expensive, but a little bit, and working to a budget is much better than not. I've got 2 people in their 40s that both have terminal cancer. This stuff happens to people. I'm trying to scare you because nobody wants to sort this stuff out, or wills, etc. So
This is kind of the list of things that, you should do. There's 20 other things in the list. You finally get to this one and you fill it up with more fun stuff through, right? And when we're talking about a financial plan, yep, we're talking about the fun stuff, right? Like, you get your house in order, buy the assets, pay down debt, get the investment properties, get the shares. All of that will fall apart if there isn't a protection strategy around that. Because like James said, it's not when something goes wrong. It's not if something goes wrong, it's when something goes wrong. And people often say to us, like, well, what if I never claim on the insurance? Like, what a waste of money. I'm like, you want it to be a waste of money.
Well lived.
You want to be like, you know what? I regret taking that out ever. Because on the flip side of that transaction, we have to have the conversations when something does go wrong. And if there's no protection in place, often we can't fix it.
Cool. Okay, so we're just about to jump to the Q&A. Before we do that, people will ask personal questions. Yeah. So we're just going to pop some links in if you want to book a one-on-one time to talk to an advisor. So I run the wealth division at Lighthouse. If you want to talk about a financial plan has a cost. We charge a fee. We're really proud of that because that means that we're looking after you, not just trying to look after ourselves. So time's getting covered. I'd say the right person for a financial plan is somebody with like a household income of like 200,000 or more than like 250,000 to invest. We'll do everything from setting goals, focusing on how you pay down your debt, talking about like whether investment property is right, investing to shares, KiwiSaver, insurance, and the projections and going, how do we achieve our goals, scenario planning, the whole thing. Yeah. So if you want to have like a free 30-minute initial consultation with a financial advisor, you can, there'll be a link in the chat. And we're also, I think for those who fill out the form, there's 2 $500 credits towards a financial plan. So there's a little bit of an incentive for you.
Yeah. And, we've basically given away the entire blueprint tonight of our financial plans, right? And what I can't stress enough is you've heard us talk about goals and taking action quite a bit, right? And the reason we're always talking about the goals is most people, when they come to us looking for help, they come to us with the widget. They're like, I want the investment property, or I want the shares, or I want the thing. They've decided on the widget before they've even kind of addressed the goals, right? And I was speaking at a cryptocurrency conference the other day. I was not on the side of cryptocurrency. And it was fascinating because I kept being like, well, what's your goal with investing into crypto? And no one could tell me. Everyone was just kind of like, I don't know. I just kind of invest. And I was like, well, how do you know when you've won? And again, you're setting yourself up for failure if you don't have really clear goals around all of this.
Okay, Mike, for those who want to talk about buying their first home, an investment property, or they've got existing mortgages that they want to look at, tell us what you can do.
So reach out to the mortgage team. We've got a team of mortgage advisors here. If you're thinking about getting onto the property ladder and you want to know, can I buy now? What do I have to do to get myself in that position? Feel free to reach out. That's actually one of our favorite conversations to have. As everyone thinks they're like 3 years away from buying a house, they give us a call and we go, actually, you can do it today, providing you can. If you've got an existing property and you want to review your structure, we've got some official cash rate price increases coming towards the back end of the year, maybe even as soon as July. So you might want to get that structure sorted so you're protected from that upside risk through the next hiking cycle. If you want your next home, an investment property, a commercial property, reach out to the team. We can give you some advice.
Cool. And then we've got our other services there as well, particularly those who are either business owners, self-employed, or have investment property. You might want to talk to the accountants because people want to pay less tax. Obviously, as well, check out the podcast. There's 500 episodes in there. But let's jump to the Q&A, Mike. Yeah. We did our best to run through that.
That is the quickest we have ever done.
I know. Doug, I've missed you. I know you've got some good questions for us. Please come back. Here he comes.
Here he is.
Here we are. What a fantastic presentation. That was honestly so quick. The boys told me it was going to take at least, 3 hours to get through, but they managed to
usually does.
30 minutes.
Yeah, there you go.
Fantastic. So we've got the QR code up there on screen. If anyone watching at home wants to scan it and add any question, they can. And for now, we have over 30 questions that I will start to rapid fire through to James and Mike. So as we kind of finish with some questions or some statements from you about mortgages and the home loan life, a good place to start would be the mortgages. So we've got a question from someone where they're saying, at what point does it make sense to switch from renting to getting a mortgage and owning your own home?
Yeah, so usually we kind of say like as early as you can. Like the data around that's really clear. The quicker you get on the ladder, the longer you're in the market. And basically, we know that people who own their own home are financially better off in the future. So when does it make sense? Basically, as soon as you can afford it, I would say.
Can I add a couple of caveats? The first one is some people stretch themselves too much in terms of their mortgage repayments. So making sure that the amount of debt you take on doesn't impact your ability to like still live the lifestyle you want right now. I've run a lot of projections of people like renting long-term versus owning a home. Rentflation over the long term crushes people. Plus, if you're just thinking about in your 80s, do you want to be like kicked out by a landlord?
Yeah. So again, it's just when you can afford it, right? So yep, you will have to make some lifestyle changes when you take on a mortgage. That's part and parcel of it. But do not be maxing yourself out. You know, we all remember 2021. Everyone maxed themselves out. Interest rate jumped. It was pretty nasty.
No, perfect. And I think that's a big thing, as you talked about, is kind of like having that, I guess, ontological security, as we call it, of owning your own home. So you can do things like, you know, putting a nail in the wall, as opposed to maybe when you're a renter, you can't do these sort of things, right? So I guess it's like when you feel ready to make those sort of decisions. And there's a lot of questions from a lot of people where they're saying, you know, I'm this age and I have this much money in savings on my mortgage, and we can't really give financial advice. So reminder to everybody in the comments there. But one of the things that we kind of seeing crop up a little bit is, when should people, maybe if they already have a mortgage, start to consider things like a reverse mortgage or a decumulation strategy? Do you guys have any thoughts on that one?
They're two very different questions, Doug. So I think reverse mortgages, I hate with a passion, is probably the best way to describe. It's reverse compounding interest. Yes, there's a reason why only one bank in the country does it, essentially. Two, is because you're continuing to pay interest on an asset over time with no income to service that debt. And the idea is that you'll die before you cap out all the equity, essentially. Around decumulation, though, like if we're talking about like we have a share portfolio or we're selling an investment property or we've got our KiwiSaver, that money's there to be spent.
Yeah.
Like I would you don't want to spend it too quickly. That's why like having a financial plan and going, I was talking to my dad about this the other day. He's like, what is my number? And working towards that number so he can go spend money in retirement, play golf, travel, etc.
Yeah, because without a plan, spending the cash in retirement is actually quite scary. Even if you know you've got a lot, you go on holiday, you're like, should I be doing this? Am I spending too much? Do I feel guilty about this? Having a plan and a runway of how to kind of decumulate and pay down that actually really does help.
Yep.
Yeah, no, that's
reverse mortgages, not our thing. Yeah.
Yeah, and I think the consensus from the MoneyHub research team is a very similar thing. We urge people to think really carefully about engaging in financial products like that one too.
Yeah.
And one of the things that a few people have been starting to talk about recently is that there's been a lot of like increase in advertisements everywhere, right? We've got social media, we've got email, we've got when we're driving down the road and stuff. And one of the ads a lot of seniors seem to be getting targeted with is insurance. They're saying, you know, whether it's to protect your future or your children's future and things like that. And some people are asking, like, is insurance a scam or not? And as you've kind of alluded to, sometimes that there might be these products that we can engage in that you kind of, protecting yourself with or against. And I guess the first question is, what's the thought on insurance and the different types of insurance?
Yeah, that type of insurance that you just described definitely feels like a scam. And I'm sure whoever's pushing that product is getting paid a fat commission.
Yeah.
Pitching insurance at older people to look after their kids is just like a horrendous idea.
It's emotional blackmail.
It is 100% emotional blackmail. Life insurance, like if you think about, and Mike's point was really valid, is if you don't claim on your insurance, it's like, I didn't claim on my car insurance, what a waste of money. It's like you didn't total a car, get yourself in a bunch of trouble, like that's a good outcome. Life insurance is going, for me, right? I got 2 young kids. I've got a wife that's not working. It would be reckless of me not to have life insurance. That's when you should have it. However, on the flip side, people get older, kids grow up, mortgages disappear, and they end up paying heaps of money in insurance. You need to make sure you're reviewing it over time. You need to make sure you understand why you have it. Income protection is one of those things that not enough people have. Our biggest asset is our income. If we get sick, essentially most people are screwed. But if you go, like I meet with you and go, you need this insurance, it's going to cost you $500 a month. a lot of Kiwis just ghost and don't do anything.
Yeah.
You're way better to have insurance for $200 a month and something in place or whatever it might be than nothing. That's how I think about insurance. But yeah, trying to blackmail old people is not good.
Yeah, and like, it's if you go directly to a product provider, like their goal is to sell the product. A broker should be able to give you advice around that. Yeah, like everyone, there's good and bad actors and brokers and that sort of thing. But yeah, if you find one you trust, they should be able to point you in the right direction there. Yeah.
Yeah, and it's really interesting. You mentioned like when you have a partner, it'd be reckless of you not to have life insurance and stuff. And one of the things someone posted was, how do you get your partner on board? Because I guess sometimes you're not always on the same place. And you mentioned before that there's a little bit of marriage counseling happening.
Yeah.
And this person saying that they tend to look forward to the future, but their partner's a little bit more in the now. And so, what are your kind of tips for bringing that conversation to the table and getting your partner to take it seriously?
Goals. It's about the goals.
Yeah, pretty much. Like, if you say to your partner, you should spend less, I can probably guess how that's going to work out.
We can
for
play
you.
that out right now.
Yeah.
I'm going to say no.
Can.
Yeah.
If you go like, hey, or even like this webinar, right? Like probably a lot of people listening to it without their spouse, they're going to go talk about stuff they want to do. And they're going to be like, what are you on about?
Yeah.
The big thing when it comes to, first thing I'd say is 9 out of 10 couples have different money personalities. So it's very, very common. I don't know, just like an attraction thing for whatever. The nerds want the wild child wants some stability, must be how it works out. But Mike is right. You can't go... everybody's got different risk profiles, different experiences how they grew up with money, etc. Not you should do this. What do we want?
Yeah.
And then what do we want for our future? And then it's going, cool. The best way to get what we want for our future without sacrificing too much now is by doing these things today. And it's very hard to argue with that.
And stagger the goals out. Set them long-term, medium-term, short-term, right? Because all of this stuff doesn't happen, like we've talked about, it doesn't happen over a week, 2 weeks, a month. This is all a marathon, right? And I'm pretty sure everyone watching this will realize that. It's not a sprint. So you've got to make sure that there is, like milestones within the goals to make sure that you can keep everyone on track. And like, that's the biggest thing with if it's saving and you're trying to get a spender on track, you got to give them little bits and intervals where they can spend a little bit of money,
Yeah, my other favorite one is when clients go, instead of going, I don't think you should do this, they go, oh, I'm not sure what James would say about that.
Yeah. Make us the bad guys.
Yeah.
It's easy. Yeah.
Yeah, and I think one of the things that people really often are thinking about now in retirement, because a lot of these questions that I'm reading through here are people saying, I'm 60, I'm 65, I'm 70, and now we're coming through with the kind of protection. And so people are saying, how do they protect their assets for future generations, like their grandchildren or great-grandchildren, without, a complex, expensive trust? Or is the trust the right solution? What do you guys kind of take on that? Like, what are the different ways to set ourselves up?
Yeah. I think, you're right, Mike.
Start with the will.
A will's a good starting point. There was definitely a point where trusts were very fashionable.
Yeah.
And I think you've just got to go, if you have a trust, why have you got a trust? So blended families and businesses are probably the most common reasons.
Yeah. But I think if you start with a will, that is a great way to kick it off. Like I've got some customers at the moment, and one of the kids is buying into the like the owner-occupied property that the parents own. There's 3 brothers. One of them, they don't talk to him, right? And I keep saying to him, you need a will, and you need to send that will to that brother so he knows before you pass away what is going to happen, right? And it's like, it's little steps like that, right? If you talk to a professional about that stuff, they can guide you through the process of, you don't need an expensive trust, but if you do practical things at the right time, it's a lot easier to sort out.
Yeah, but if I can, that comment dug around a lot of like people in their 60s, 65, 70s, if I can just talk to them for a second, there'll be varying degrees of wealth on the call. My big thing I would say is just, whether it's with us or someone else, just whatever you want to do, having a retirement plan. There is, if you've got some spare time, read the book Die with Zero. It's the concept that like money is a tool and energy to live the life you want to live. Either you retire earlier, you spend it, or you give it away earlier. I would not be going like, I'm going to leave a lump sum for like when I'm 90, because your kids will have done all the hard work by then. They're going to be like 60, 65, and work out how much you need. Either you spend more or you do those head starts earlier. And it's so gratifying to see like people be able to, go. I've never had a person do that, assuming that they're looked after first, their retirement's looked after first, go like, that was a horrible idea. Yeah. The impact it makes on, it's just such a feel-good moment.
Yeah. And I think that's a really good book. I've read that one, and I'm a big fan of that mantra. One of the things that you talked about in your presentation, which I thought could maybe have some more time on it, because we have about 20 questions all asking the same thing now. And it's actually, when do I pay off the mortgage versus when do I invest in things like the market?
Yeah, it's the most common question we get in our presentations. Pay off your mortgage before you invest into shares. Let's do the math on this quickly. If you get a 10% return on shares and a long-term mortgage interest rate's 5.5%, let's say you take off 1% a year for tax. Yes, you can invest into lower things, but just because it's a nice, easy number for me. 3%, 1% for fees, 3% for tax. Yes, there's different structures. Most people invest into a pie fund. And then 3% for inflation, because you're not spending the money now. Even if we add back a little bit, your long-term return is somewhere between 3 and 4%. Your mortgage is at 5.5%. There's no tax, there's no fees, there's no inflation, there's no volatility. There's no inflation because you never plan to spend the money opposed to the shares. Plus, for a lot of people, like 50% of their income is going towards their mortgage. You remove that, and you have all of that cash flow to go and do something with. In addition, if you're interested in investment property, you pay down debt. You're allowed to use leverage sooner. So a huge fan of paying down debt, not just because of the math, but because of the impact on the quality of your lifestyle and other options that it frees up.
Yeah, and so that's specifically around like a lot around the share side of things. If you're looking at investment properties, again, it comes back a bit around to like the goals, the affordability, and then time in the market. Because if you if you pay your entire mortgage off first before you get into an investment property, often you'll end up missing quite a substantial period of time that you could have been investing into property in the market. So for those customers who are thinking about investment property, that's probably more of a personalized question. I would say if you're thinking about it and you're like, I wonder if I can afford it and I wonder if it's right for me, have a chat with a mortgage broker. It's not like we will run out and get you the debt and make you spend it straight away. We'll talk you through the strategy, talk you through the affordability, and really just go, are you going to be able to sleep at night as well?
Yeah. And I think that's the main thing, right? It's like coming to you guys and having a chat about what they really want to do in terms of their goals and how to get there is the best way to go about this. Because as I keep saying, all these questions are very, very specific, so I can't actually ask a lot of them. But we've got a couple that are kind of referencing what might happen to New Zealand super for an individual who's worked here for a number of years, and then moves overseas and works a little bit and then comes back. Does anything happen with their super payments?
It's case by case. I think a lot of the time it's like you have to be back for 10 years.
Yeah. And then there's a limit on days in the country as well.
Yeah, but like you could call Wins and like talk them through it and go in this hypothetical sort of scenario, how would this work? I didn't think that was the question you were going to ask me, Doug. I thought the question you were going to ask me was, do we think New Zealand superannuation is going to be around in the future?
Yeah. Let's talk about that. I like the sound of that question.
Yeah, so like we've had the Retirement Commissioner on our podcast before. Tough job because you throw out ideas, but you have no ability to execute any of them. But when it comes to New Zealand superannuation, a lot of the data goes, yes, it's sustainable. However, if you look at the math, in like the 1970s, there was 7 workers to 1 retiree. In 2060, it's 2 workers to 1 retiree. Over 50% of government spending will go towards healthcare and New Zealand superannuation. Yeah. That is a formula to me that goes like, how does this math stack up over time, especially when you're looking at other parts of the world? I think means testing is quite logical at some point and will likely happen whether people like it or not. I also think you've got to go, what kind of person do I want to be? Do I want to take control of my own future and assume that I'm going to sort out myself, or do I want to be dependent on someone else? And I know which camp I would pick.
Yeah.
Yeah, no, that's some really good points. And I think one of the things also that makes New Zealand quite a unique country is this concept of KiwiSaver, right? And we have a government scheme here, which is very, very new compared to some of the schemes overseas, and has very low contribution rates compared to the ones overseas. And so what we see is we don't really have the same amount of money in there to be able to, sometimes some people will say, achieve as many things, but it can still be a good investment vehicle. And so one of the questions that a couple of people are asking is like, well, hey, should I put my money in my KiwiSaver, or should I just put it in a managed fund where I have some more control? When you talk to your clients, what do you kind of give them in terms of advice with that question?
Managed funds every day of the week, index funds, potato, all the same thing. A KiwiSaver is just a managed fund. That's all it is, except it's locked up. So if I can have the same thing with or without flexibility, you would pick flexibility every day of the week.
There is one exception. If you are bad at managing your money, and you know you're bad at managing your money, then maybe KiwiSaver might be right for you because it is locked up and you can't get to it. And we know people who actually, KiwiSaver, yep, that is the right option for them.
Yeah, we did that with my brother. We ramped him up to 10% contributions. He now owns a home because like he just didn't have a choice.
Some people don't have the discipline, right? And I assume most people on the call probably have the discipline to put it in a managed fund. But yeah, for some people, if you're honest with yourself, like if you really want to lock it away, then that is the option. But that's really the only real kind of, there's no other advantage to it. No one's matching your contributions or anything.
Yeah, the same logic applies with kids' accounts as well. So if you're investing for your kids' future, one, get out of a bank account, get into a long-term investment vehicle. Two, don't invest into KiwiSaver. I've got a 3-year-old and a 5-month-old. What will the property market look like by the time they want to do something? Who knows?
Yeah.
I'd much prefer them to have flexibility with that money. So there's no benefit in locking it up in a KiwiSaver.
Yeah. And I feel like a lot of these questions that you're being asked today are ones that you've probably been asked 1,000 times. So I'm going to throw a couple of curveballs at you to try and get you thinking. So one of the ones that I'm personally interested in is, what financial topic do you think that we don't talk about enough in New Zealand or doesn't get enough attention? What do you you get up on your soapbox, like, what do you want to talk about?
I know mine.
What is yours?
Mine's probably unacceptable. Mine is insurance. Mine is insurance. And I'm a mortgage broker, so I don't give advice on insurance. I think, and the reason I think that is, the longer that I go through my career as a financial advisor, unfortunately, the older I get, I have clients who've been around for a number of times, and now we're starting to see people where events are happening in their lives where it just rocks them, right? Shakes them to the core. The finances go out the window, and those are really tough conversations to have, and they are made a lot easier for everybody involved if there's some sort of cover in place. Yeah, and I don't want to bum everyone out on the call,
That's a good point because, with the podcast, we can talk about shares, property, setting goals, starting businesses. People love that
commercial
stuff.
property, sexy stuff, make the money. Yeah.
If we do an episode on insurance or wills, 3 people will watch it.
Yeah, but it's hard though, right? Because you're no one wants to be reminded of their mortality. Everyone thinks it's a waste of money. It's just that, unfortunately, personally, I have to have discussions with customers where I'm like, we can't fix this. You've got to sell the home.
Yeah, but the probably the other big thing for me, Doug, is just the thing I'm super passionate about is, people get dealt differing hands in life and all that kind of thing. But I definitely think a financial plan is all tied to what are your goals, and a huge part of that is around your income. It doesn't take a genius to work out that people who earn more money have more options.
Yeah.
A good financial plan should not just be I want to invest in property, invest into shares. It's going, what is my plan around my career to get my income up so I have more disposable capital if I'm disciplined, and then I can accelerate the plan faster.
Yeah.
Yeah. No, I like it. And those are very, very strong points. We are almost out of time, so I have time for a couple more questions. One of them, which is rapidly gaining popularity, is someone's friend is asking them to buy a house together to ease the mortgage payments and build equity. But he's a single young adult and the other person has a family. Is it worth going into owning a mortgage with your best mate? Or
Well, we're best mates and we have mortgages
We got a bunch
together.
of
We got
investment
a
properties together, but,
ton of mortgages together. However, the difference there is we are at a similar age and stage, right? If you are going into that level of financial commitment with someone, you're married to them effectively, right? For better or worse, like you're in this together. So the fact that you're asking that question leads me to believe that perhaps it's not the right investment. And before you did it, I would explore all of the other options. If it was the only option to get on the property ladder and you really wanted to do it, okay, that's fine. However, there are a ton of ways out there to get on the property ladder by yourself, and like, kāinga ora first home loans, 10% deposit loans. There are, really affordable properties out there on the market, depending on kind of the areas you're in at the moment as well. So, I always tell people, if you can do it by yourself, definitely do it by yourself first before you dive in with someone else. If you're going to do it with someone else, right? What happens if it all goes right? What happens if it all goes wrong? And how do we get out of this thing? And what happens if it all goes right is a really tough question, because what happens if in 5 years property value's gone up, but I can't afford to buy this person out, they can't afford to buy me out, we have to sell it. So yeah, there's a ton of stuff to work through, but do it by yourself first before you do it with someone else, or try to.
No, that's fantastic. And I think with the final question, what I want to ask you guys is, what is for each of you your favorite moment from working as a mortgage broker, financial advisor, whatever hat you want to put on for that to answer this one? What is kind of your favorite story, your favorite moment of when you've helped someone and they've achieved something that you can share with us?
Yep, I had somebody come into my office maybe like 5 years ago. And I think there's a big piece of like people being disappointed with the position that they're in financially. They couldn't look me in the eye. They were embarrassed by their financial position. They were like, we probably know that like you can't help us, all of those sort of things. And we worked through their budget, the assets they have. 5 years later, they've been managed to not just buy a home, but pay off the mortgage. And they've got a clear plan to retire. And the story there is going like, the Warren Buffett quote, the best time to plant a tree was 20 years ago, the second best time is today. Either way, you're going to be in the shade at some point in the future. Is that obviously, if you can start really early, then you're going to end up in a really strong financial position and you've got to sacrifice less. But just to put your head in the sand and not to have that conversation and be brave enough to do it and to go, what are my options? It can make a really, really big difference to someone's future.
Yeah. Mine, I don't have a slick Warren Buffett quote, but like honestly, it's my first home buyers, and like I could rattle off a few of them, but like
the webinar ones are a lot of fun.
Yeah, just like when someone watches a webinar, this isn't like an ad for anything, but like when someone watches a webinar and goes, I reasonably think I'm like a decade away from buying a house, they get in touch. I'm like, you can do it tomorrow. Like, let's go do this thing, and then you get them a house, and like honestly, you kind of like fundamentally change their lives. Like, they'll be financially better off in the future. And like getting someone their first home is great. The bit I love most about that is how much real estate agents hate me, because I'm like, no, they are lying to you. Do not increase your offer. Like, we get stuck in. Yeah.
Because the bit around like people buying their first home, like if you've been working for a few years, you've got 30 grand in your KiwiSaver, your partner's got 30 grand in your KiwiSaver, and you're both earning like
you got 20 grand in savings.
Yeah, you got maybe earning like 80 grand each or something. You can probably buy a house.
Yeah. So like everyone's a lot closer than they think. Yeah. But aside from that, it's how much the real estate agents don't like me, because I get stuck in negotiations with them. Yeah.
Oh, that's wonderful. Well, thank you boys so much for this. I really appreciate it. And everyone on the stream has absolutely loved it. We've had the comments, we've had all the questions popping off. So I'll let you guys say a thank you, and then I'll wrap up.
Cool. Yeah, awesome. Yeah, thank you, everybody. We're keen to do more of these with MoneyHub, so please make sure to pop in the comments what other webinars you want us to do. Just jump on the Lighthouse website, whether it's to check out the podcast or to see how we can help. We do like free initial consultations, because we are very sincere that we want to help Kiwis secure their financial future, and whether we can help you buy a property, plan for your retirement, or we just give you some pointers. We're here to help you when you need it.
Yep, that's good sign off. I'll leave you with that.
Awesome. Thanks, guys. So with that, we have come to the end of the webinars. Thank you, everyone, for tuning in. This link will be turned into a video on YouTube that you can rewatch at any time. And if you have any questions, just make sure to email the Lighthouse team. We will send you an email with an email address for you to email your questions to. That's a lot of emails. And also, don't forget to fill out the feedback form and go in the draw to win a few $100s of financial credits with Lighthouse. Thank you so much, and we'll see you in the next one.